Okay, here's some examples of sampling of the test of controls from chapter 15. So we have an audit of the financial statements, and they've applied non-statistical audit sampling in the test of controls and substantive tests of transactions for their sales transactions. Um, so, so based on her knowledge of this company, she decides that the estimated exception rate is 2%, and that she's willing to accept a 10% risk that the true population exception rate is not greater than 6%. So, given this information, she randomly samples 100 sales invoices from the 5,000 that were generated, and then she goes through and looks for exceptions. So these are some of the exceptions that she finds again in the sales transactions. So then what they want us to identify is, as we look through these, would this be an example of an exception? And then explain, um, again, each one of them should be considered separately, which is what we're going to do. Then calculate the tolerable exception rate minus the sample exception rate. So again, they tell us in the problem that her tolerable exception rate is 6%, right? So that's what it is. So then we'll look at what the samples end up being, and then what should they do to kind of look over some of it. If they encounter these things, like what would be their next steps? Okay. So for this first one, she pulls this invoice, and the sales amount of the invoice was incorrect because there was an incorrect product number that was entered. So that would be an exception because, again, it's an error, and you don't know, they don't give us dollar amounts, but again, depending on the product, it could be a decent amount difference. And then what we would do, so yes, it's an exception. What we would do is we really should try to find out like who entered that invoice and possibly look over some of their other invoices that they entered to make sure it was just a true key punch error and that it wasn't something that they perpetuated, throughout the year. And that it ends up being a bigger problem again, because key punch errors happen, but if they, don't understand a process and they're always putting in the wrong product number, that could result in a bigger error. Okay, then the next one, the quantity on the invoice does not match the quantity on the shipping documentation or the customer order. So it sounds like the customer ordered, a certain amount, they shipped that amount, so the customer is happy, but then they didn't end up billing them. So again, depending on which way that would go, like, did they bill them too much? And then obviously the customer is going to complain. If they billed them too little, the customer might not say anything. And then the company's going to have to eat that cost. And then if it's a one-time thing, no big deal. So it's almost the same as the top one where you want to identify who processed that invoice and then go back and make sure it's not a repetitive mistake that was made over and over. It's just a one-time mistake. Okay, then we have the shipping information on the sale of merchandise could not be located. So we've got an invoice, but we don't really have any proof that it actually shipped. So then you want to go back to like the next level to say, okay, well, confirm that it's on the accounts receivable and that the people actually paid. Or then you could go the other direction to test it. Did we see that inventory came out of our actual inventory? You know what I mean? So whatever product we have on this invoice, did we actually see it come out of inventory and be shipped out? So just test the process that it really went through and that it really got paid. Okay, then there's a sales invoice for $2,875 that has not been collected and is 6 months past due. That is not an exception. So there's no one did anything wrong there. You can't predict when customers aren't going to pay you. That's why we have the allowance for uncollectible accounts. So this one is not an exception. Then the next one, the client is unable to locate the sales invoice. So we see it in the ledger, we pull it, we ask them for a copy, they can't find it. So then we're going to want to do some other methods to get comfortable with it. Trace that invoice into the accounts receivable, see if the customer then paid us, trace it into the sales journal to make sure again that everything was properly accounted for, and that it's just again a true just discrepancy that they couldn't locate it. Anything more now, everything is so digital that probably doesn't happen that frequently anymore. When you had hard copies, those things could happen, but now that everything's kind of digitally generated, that's probably not as common. Okay, then the next one, we have the invoices dated 3 days later than the date entered on the sales journal. So again, it goes back to like, well, who did that? And maybe test some additional of their transactions just to make sure it was a typo, nothing intentional, that they're not trying to move sales from one period to another period, just to ensure that it was just an honest mistake. Then the next one, the client is unable to locate the customer order, although the invoice has been paid. So again, look through the others, so maybe increase your sample size a little bit to look through to make sure that this isn't a common occurrence, that we can't find the customer orders for other ones. Because again, we know it's a legitimate transaction. We just want to make sure it's not something that's happening all the time. All right, then billing for $100 less than it should be due to an unintentional pricing error, and there's no indication of any internal verification in that invoice. So just a true billing error, but you'd want to definitely check prices of the product. So again, if it's a specific product or service, then trace that through to other customers' invoices, make sure it was billed properly there. Actually look through that particular customer a little bit more to see if maybe, like say it's a friend of a friend and you're giving them $100 credit on every invoice. See if it's, if it's something that's not unintentional, but actually intentional. So just kind of trace it to some other customers, that same product, and then look at that same customer and go back through some other transactions to make sure that it's just a one-time thing. And then again, the client is unable to locate a shipping document. And again, I feel like those ones are a little bit less common with everything digital. There isn't hard copies anymore, but back in the day when there was just hard copies, you would just have to get comfortable again that that inventory actually left the building, that it went to the customer, that the customer paid. You trace it through the rest of the ledger to be sure that it was a valid, true sales transaction. And then the customer was not included in the approved customer master file, and the sale was only for $47. I mean, really, it's a minor amount, but at this point, we're looking more at their internal tested controls. So you would want to make sure that that doesn't happen on a regular basis, that customers normally are approved, and that there's credit checks and things like that are being done. So again, you may just want to increase your testing, pull another couple customers to make sure that they are approved. And then there's lack of evidence of verification of pricing information. So that again is just going to be another one to make sure that like the other invoices to that same customer, that the pricing is correct, and that if it's a specific product or service that's being billed out, that when it goes to other customers, that it's again is at the correct amount, that it's just a one-time error. So those again, all of them except for the one that was unable to pay, all of those are exceptions. And if you kind of go through them, we have a couple that relate to shipping documents. We have a couple that relate to errors on the sales invoice. We have 2 that relate to pricing errors. And then we have 2 that relate to like pricing extensions, like maybe there's something up with, how it's calculating out on the invoice. The other ones were all just kind of just 1. So then when you're looking at when you're calculating out, you're taking your tolerable exception error minus your sample exception error. That tolerable exception error was 6%. The most that we have in these samples are a 2%. So then that leaves a 4%. That leaves a 4% rate. So then if is that any cause for alarm really, based on this level of transactions and based on her willing to accept that 10% risk that the true population, you know what I mean? So no. So I feel like none of those rates are too high that would indicate that she can't still be comfortable with the internal control process based on this. Okay, so I think that is that